Well, there's a lot going on in financial markets. There always is, but we've hit a crescendo. We saw the Australian CPI numbers yesterday. That's effectively taken a November rate cut off the table. We've got Megacap earnings rolling in at the moment. We've got a Xi-Trump meeting very much in play, although we've seen quite a lot of headlines coming out ahead of that situation. We've just seen a Fed meeting, a slightly hawkish lean, and we discussed that situation as well as the US government continues to roll on and frustrate some in the market. But the Megacap tech stocks continue to roll in like thunder, and we'll discuss some of those the market moves that is coming through in that situation. Now, big reversal coming through in gold. The dollar's playing a bit of a moving upside, and we look at markets on a cross-asset basis, and Blake pulls out the beans as he looks at soybean trades ahead of the Trump situation. This is a trade-off. Well, g'day. I'm Chris Weston, Head of Research here at Pepperstone. We're joined in 2 seconds by my good friend and colleague, Blake Morrow from Forex Analytics. And we were discussing all the factors that are going on in this crazy world of financial markets, all the setups, the movers and shakers, and the setups and factors that we like in this situation, and the directional moves that are front of mind. Mr. Blake Morrow, my good sir, would you come back into the program? How the devil are you?
I'm doing good. It's been a long day, Chris. It's been a long day. We've been going nonstop with the Fed, and it's just going to continue into your day today.
Well, what I like about this is you've got exactly the same hairstyle as me, just in a slightly different fashion. Your wind's blowing a different direction. But I hear you're going to be staying up throughout the Asian session as well. So either you're a sucker for punishment or you see money to be made in these financial markets.
I see money to be made, baby. Actually, I think the BOJ is actually going to be a good one. I think, but also is this China-U.S. trade talks with Trump and Xi, which we're going to talk about as well. So, I think a lot is going to be happening here over the next several hours.
Well, let's discuss it. Who would better discuss it than Blake Morrow? So let's crack on. Let's go topical thunder. Well, let's start with the Fed meeting. Expectations pretty low ahead of this situation. We got most of those situations. We've got the 25 basis point cuts. We saw Powell in his press conference kind of pushing away a little bit from the December pricing. That was an 85% probability for a cut in the December meeting. He said really that nothing was really pre-planned, and he sort of pushed back there. The expectations or the implied probability of a cut has come down to 65%. Obviously, we've seen the formal end of quantitative tightening. They'll be looking to reinvest the proceeds from maturing bonds coming through into shorter duration maturities there. So effectively the weighted average maturity of the Fed's balance sheet now will come more in line over time with that of the outstanding stock of debt in the markets, and that's an issue. But that, probably a sort of consensus trade. But I think that pushback and the lower pricing of implied pricing for December, and also further out the curve, we saw about 9 basis points of implied cuts coming out for the sort of entirety of or the cumulative pricing there. So we have seen a bit of a dollar rally. We've seen front end yields moving higher, equities down a touch. So the market has taken this one as a bit of a hawkish lean. The question for you then, Mr. Blake Morrow, is this move sustainable in terms of gold lower, dollar up, front end yields up, or is this just a one-day affair?
I think this is a one-day affair, at least for now. But I don't know if you're watching when that headline hit, when Powell said, December is not a foregone conclusion. It's far from it. And soon, when he said that, the S&P dropped, about 60 handles, and we quickly recovered. And so that knee-jerk reaction, I think, is a warning. It's a warning shot that the market's taken, saying, "Look, we want a rate cut. You better deliver us a rate cut." Now, I think it's just a one-day affair because the market still is going to be looking to get a rate cut for other reasons as well. But also, don't forget, tonight, President Xi and President Trump are both meeting in South Korea, and we're expecting some great things. So, the market's like, I don't want to miss that. So that 50-point, 60-point S&P sell-off was just a buying opportunity for dip buyers. But I think the instant reaction kind of showed us what we'd be in store for if we don't get what we want next month. Well,
there's other things as well. We saw, obviously, there was two-way descent, which I don't think was expected. Obviously, we expected to see the 50 basis point situation coming, but it was Jeffrey Smed from the Kansas City Fed who said, "Do I want to see rates on hold?" That was a small but unexpected situation. Now, with the government shutdown very much in play, and we don't know when that's going to finish, both sides are still a million miles apart at this side. Powell did say that they are getting some pitch, getting enough of a picture in the jobs read without getting payrolls and some of the other official data. He's looking at the beige book. He's looking at obviously the state claims that come through. He's looking at jobs hard to get as part of the consumer confidence number. All these factors give them somewhat of enough of a picture to see a cooling of the labour market, but they are seeing greater two-way risks coming through. And I think, as that goes, there's still a bit of data, a bit of time to pass before the next meeting on the 10th of December. Obviously that implied pricing for December and further out the rates curve is still a moving target, and that makes it very difficult to price risk because the Fed are still working with sort of anecdotal evidence and tier 2 data releases, which they wouldn't necessarily put so much weight on. So we are trying to understand exactly what they said. So I think it probably means that, their guidance in various meetings, in various speeches, probably gets a bit more weight in the short term here. But obviously, it would be, we're getting to some key dates coming through. 1st of November, we talk about the shutdown in a second, but we are getting some key dates in the shutdown timetable where things will become politically very sensitive into the voters and probably have some impacts on the midterms for next year.
Absolutely. And before we move on, Chris, and we're going to move on to the U.S.-China trade situation here in a second, but I want to ask you, QT, we're ending that, or the Fed's ending that in December. Could they have done it for November 1st?
Well, Powell said that in the press conference. They just wanted to give the market a bit more time just to digest all the situation and get this over. So, it could have done. Maybe that would have spooked the market. That they're a bit more, that the urgency expressed is more of a concern because, reserves have fallen to $2.93 trillion and that's come to the level of ample. But we've seen, really since the start of September, the biggest metric that you look at is SOFR has been trading at a premium to the interest on reserve balances, which is the upper corridor effectively. And so that's been above that level for some time, showing that traders are seeing reserves as less ample and, getting into a sort of scarcity, and that's putting pressure on funding markets. So, there's a balancing act. They could have done it sooner, and that may have set off alarms that, if they were getting more concerned about reserve scarcity. And that may have shot. So by giving them a bit more time, it shows that they're feeling like they're in control of this situation. And to be fair as well, there's also quite a lot of people out there, Citibank and other banks, who'd been saying that QT should actually stop formally in December, if not January. So that in some people's eyes, this is still a sooner rather than later situation. But look, reserves in the system are going to continue falling. Even though the balance sheet will be kept on hold at current levels, reserves will continue falling just because non-reserve liabilities are going to increase. Things like currency are going to continue. So at some stage, probably the bigger question will be, when reserves do fall to about $2.8 trillion, what will the Fed do about that then? Because that will be the next stage. Do they need to put more liquidity into the system? Do they need to start QE in some sorts of capacities because they would have reached the sort of lower bounds of where reserves can go before? So, I think that's the question, Josh. I don't think whether they should have stopped it now or December's. The issue, which I think a lot of people to start focusing on, is when reserves do fall to a certain level, is what will they do about that? Will they start some sort of operational twist or liquidity injections or QE in some sort of capacity? Because they'll need to see reserves increase again. Otherwise, the funding markets could be quite interesting there. Yeah. This sets you up nicely for your next topic.
Yeah. All right, so let's talk about the U.S.-China trade situation. That comes tonight. Like I was mentioning, President Trump and President Xi are both meeting tonight, and there's I'm wondering. I mean, the market's been pricing in this grandiose deal, between fentanyl, soybeans, and I'm sure a host of other things. And the Trump administration's obviously been touting this, this situation up, but I haven't heard a peep from China. And we were talking about that in our community today. We're like, Xi's been eerily quiet. One of my colleagues, his name's Kay. He's like, man, we haven't heard a thing. What are the chances? What are the chances that Trump doesn't get what he wants and walks away from this meeting kind of disappointed? I'm worried about that, just because I think the market is so over the hill at this point that something is going to get done that's substantial, that's going to really bring down tariff rates. We're not going to hit that 100% tariffs on November 1st, or whatever the number is, 130%, 140%, whatever it is. What are your expectations, and how do you think this is all going to play out over the next 24 hours?
Well, there's three variables. The first one is that China relaxes its controls around the rare earths. So at the moment, if you're a US business and you're using Chinese sourced rare earths, any element of trace in the product that you're exporting, you need to apply for a license that from the Chinese government to do that. So they'll need to see some sort of relaxation of those controls. The second factor is the Chinese start purchasing soybeans. And then the third factor is a more stringent control on fentanyl. We've already seen the Chinese now buying the first purchases of US soybeans are for, I think, since 2022. So they don't need to say anything. Those actions have resonated there as well. I don't think it'll be a particularly hard order for the Chinese to come out and say that we're putting even stringent controls on fentanyl. I think that will be an easy one for them to get through. So it's the rare earth side of things, which I think that's their point of leverage. That's this race to become the dominant AI player by 2030. That's the bargaining chip, because that's where they can hold US companies back from dominating this situation. That's where they can control the price effectively of the GPUs and the chips, and that that's going to play into the margins of these companies. So that will be the sticking point if it comes through. So will that be enough to appease Trump? I mean, I think you make a really good point here, because the market is high on optimism that something very positive is going to happen. We obviously saw the gap up in the futures on Monday, and it's sort of that would cause a breakaway gap in futures, S&P and NASDAQ. And we've seen a very strong positive bid in the market. But are we overpricing that situation? And I think I suspect there's always a deal, right? And I suspect it will be a positive one, and the markets will move on from this. But I think it's a risk that we need to keep a beady eye on. And I can understand why, you'll be staying up all night just to make sure that it does go the way it needs to go.
Exactly.
I mean, I think the other factor, again, we're just sort of going over, and I know I'm going to get scolded and smacked on the back by my producer at the back of this. But the other factor, of course, is on the 5th of November, we've got the orals for and against the IEEPA tariffs in the Supreme Court. So this is where, a lot of the businesses in the US have put up plaintiffs to come out and argue why the IEEPA tariffs were illegal and overstepping the administration's use of tariff powers to get them done. And obviously, Trump administration will be campaigning and saying why they are needed under the US situation. So you're not going to get an answer for that straight away. They're going to be putting the orals exam for and against on the 5th. The US Supreme Court will judge that, and we may get an extension, or we may get a categoric answer that's illegal or non-illegal straight away. And it's a lot more finer points to that. But I think that's a risk that needs to be looked at, and it might not come through December, it might even come till January. But if the IEEPA tariffs are deemed illegal, and even worse, if businesses in the US go, actually, do you know what, we've paid a shitload of tariff revenue out for these imports, and therefore we want to make a claim on the US government for these. I think that would be a big situation that would actually ultimately lead to a dollar negative result. So I think that's something that we'll be looking at very closely. But again, timing. It's not like a payrolls number or something where you've got a scheduled, defined time it's going to come out. Those headlines won't pass 5th of November, could come out any stage. So it could be high alert for that. Anyway, let's move on to the earnings side of things, Blake, because obviously we do have a massive week of earnings. We've seen quite a few companies coming out so far. Meta's just hit us with numbers, and their revenues numbers were pretty good actually, but they've got much higher expenses. Their capex numbers continue to increase. Stock's down 8% after hours. We were expecting a big move in Meta. Market was pricing in a 6% move, but this is another company that's seen a higher volatility move so far relative to the implied move from the options straddle pricing. We've seen Microsoft coming out, stocks down a little bit. Obviously, we saw some numbers coming through this week, 45% of the S&P market cap coming out this week. So it is the lion's share. Tomorrow we've got Apple, which has done very nicely recently, really strong move so far, and Amazon as well. And Amazon's been a frustrating trade for a lot of people because, a lot of the other hyperscale businesses have done very well. We've seen very strong growth coming through, not so much in Amazon. And in a crowded trade, people have sort of said, well, let's move on to things that are working. AMD's been smashing it. Alphabet's been smashing it. We saw numbers from them. So, I think it's an interesting one coming through. I know you're not necessarily a stock-specific guy, but I think when you've got 5 of the Mag 7 stocks coming out in a 2-day period, how much do you sort of put a BDI on it, and what sort of names have you focused on?
Well, I'm gonna focus pretty heavily on Amazon and Apple tomorrow. I mean, the futures were hit a little bit after the close today, and I do pay attention just because I do like to trade the S&Ps. The S&Ps is one of the markets that I've really focused on over the last few, like I would say this last quarter. I was pretty vocal in telling all of our traders that I'm like, I've reallocated funds towards the ability for me to be on both sides of equities so I can trade both long and short. So I will be focusing a lot on Amazon and Apple. And I think Apple is one of those companies that it's not as widely held as Nvidia, but it is a staple in every hedge fund's portfolio, or in every institution, any portfolio really. And so Apple's going to be a big one for me. And I have to say, I know I've mentioned this for years. Amazon is all about the ecosystem, and it's not about ingenuity and excitement anymore. It's almost like the modern day electric company. A lot of us, we just pay Apple. I pay Apple for storage. I pay Apple for. I got a new i17 that I just replaced from a couple generations ago.
I can't get mine. I'm out of contract and I'm waiting for it to come through. There's a shortage in Australia. At least in Telstra.
There's a shortage here, and it took like 2.5 weeks to send it to me, and then I transferred and I just returned my other phones a couple of days ago. And frankly, I like my iPhone 13 better, to be frank. But anyway.
All right, 70-year-old Blake.
Yeah, I know. Give me my Motorola StarTAC. I want my StarTAC. Anyway, some of you might have got that one. Regardless, I think earnings are big. And I've seen a shift, and we'll get into the next subject. I've seen a shift, Chris. We're starting to see earnings not as explosive as they have been for the last for the rest of 2025. So we're starting to see a little bit of mixed reaction, maybe because its expectations are so high, maybe market's a little frothy, whatever the case may be. Anyway, last thing I want to talk about is the U.S. shutdowns because I remember, Chris, I'm old enough to remember just a few weeks ago when you were like, the shutdown is like it's got a handbrake, it's got a natural handbrake. Well, the way I'm viewing it right now, it's like Chris Weston, driving down the road, and he has a stogie in his mouth, hanging out of his mouth. He's driving down the road with the wind in his hair, and he throws a stogie out, and it falls inside of the car, and he goes, "I need to hit the brake," and he can't find the brake. Are we there yet, Chris, where like we can't hit the handbrake? Because we're going into, I was just looking at Kalshi's odds. There's a 47% chance that we're going to have a 45-day shutdown or more, and we're still at an impasse, and it doesn't look like there's any hope in sight. So when does the market start to worry?
Well, I think you need to adapt on your little analogy there. I've got a roll bar, bullhorns coming out the front. I've got Maccas on the side next to me, maybe a Union Jack flag behind me, cowboy hat. And then I think you've got something a little bit more abrupt in that situation. But I think 1st of November, the healthcare premiums go up on the Affordable Care Act for people under the program, right? So if there's no deal done before the 1st of November, those premiums go up on a lot of people, and that's going to become more expensive. So the Democrats will be very, very keen to avoid those healthcare premiums, because if the shutdown happens after that point, those premiums have gone up. So that seems like quite an interesting one. And we talked about this idea that previous government shutdowns of like the last one, which went on for 5 weeks or something, came out because they couldn't get the security. I think it was at the New York airport, and so the flights were getting disrupted, and and that hit back. There was a handbrake because certain critical staff that impacted national security couldn't come through. And these are all sort of things we're looking at. Eventually, people are not going to get paid. People can't go to work. That are providing national security to Americans, and that's a factor. Healthcare premiums are going up. So these are all the factors that. Yeah, there'll have to be some sort of deal. Otherwise, it's going to be a strong detriment. And then it comes down to, well, if the Democrats can't get it done, how they sell that to the voting population that this was purely a Republican issue. And of course, the Republicans don't want to see an expiration, a deal on AC, Affordable Care Act, because, they really need to get healthcare cuts done in the One Big Beautiful Bill next year. So it's going to be very interesting. The longer this goes on for, we know it's going to have a modest impact on growth. Some of that growth will be pulled back. But yeah, as I say, when the security of Americans is impacted at some stage, healthcare premiums are going up on something that could be avoidable. That's where people start getting pretty upset about this situation and demanding action from both sides.
Where's the handbrake? And I'm sorry, guys, this was such a U.S. heavy show. I mean, but it seems like there's a lot happening this week. Well, there's America, and there's 25 other people who live outside of America in most people's eyes, right? So there's other countries. Anyway, but no, you're right. I mean, we can focus on the Bank of Japan, but most people aren't really that concerned about it. Most of the stuff that if the best way I look at this right now, if anything's going to derail this juggernaut of risk, it's going to come from America, right? It's going to come from something that's happening in America. It's not going to come from Europe. It's not going to come from. Doesn't look like it's going to come from China after their fourth plenum. If something is going to derail this love affair we have with risk at the moment, it's going to be something US stateside. So I guess that's where we need to focus the risk attention. There we go.
Anyway, let's go to that's the setup. Got to bring up gold. It's getting a lot of attention from clients, as it is with the underlying market. Obviously, we saw that absolute ripper of a move from August into the recent highs. And yeah, I think a lot of people have predicted the reversal. A lot of people have traded the reversal. Some people have been buying dip and it's hurt. I don't think anything necessarily much has fundamentally changed since getting to 4,400. It was just the elastic band was primed across all markets. I mean, in options, we'd seen skew showing a decent premium for calls over puts. Obviously, we see monster inflows into the various ETFs, some absolute crazy inflows, and those flows potentially abated, and we're starting to see outflows again now. Positioning in the underlying was obviously pulled back, and it was just we got to that saturated position, and obviously, when you've got a boat and everyone's on the boat, 100 people on the boat, and they all stand on one side of that. It pays. And I think what we've seen here is it started off with a lot of the fast money community coming down, jumping out just because the risk reward had shifted. On Monday, we got the Trump headlines coming through, mainly from Scott Bessent, that we were going to see some sort of deal emerge and that everything was looking pretty hunky-dory there. And people said, well, maybe that's the reason to take profits on this one. But we have seen maybe CTA is cutting back on long positions. I don't know where the first exit level is. But yeah, I mean, it's been a rapid move up. It's been a rapid move down so far. We've gone through the 38.2% retracement of that move. We're coming down into the 50% of that move already. So it's been like up the elevator, down the elevator so far. And it feels to me that this is a seller's market now. I think there'll be a point, the 61.8% retracement of that move, but maybe by the point we get down to, because I think this primarily is just a positioning unwind. The fundamentals for gold haven't necessarily changed, but it's been a rampant positioning unwind, and therefore I would be cautious from buying this one at the moment. I know a lot of people are saying you're an idiot, Chris, but for me, look, every rally seems to be sold. I think it's a seller's market. The tactical play for this, again, in a market that's falling fairly sharply now, is if I'm looking to buy, don't buy the dip here. Wait for the market to do the hard work for you. And then, as I always talk about, buy the rip after the dip. Let the market tell you that the selling's abated, that the buyers are having more of a say. The tape seems to change. There's a dominant in terms of the flow aspects. And when you get that higher high and you can see range expansion on that, it will tell you that the positioning unwind's likely over and you've got a high probability of that buying. So I wouldn't be catching this falling knife. Let the market do the hard work for you. Wait for the change in structure and price action, and buy the rip after the dip. That's why I'm playing this.
You know what's great, Chris, is when you have volatile moves like this, like big moves like this, it's much easier to identify when the selling's over. Yeah. So yeah, just like Chris says, I think that's a wise decision.
Is this a positioning unwind, or is there a fundamentally different backdrop than there was 2 weeks ago or when we got to those highs? I don't think anything's really changed. Rate cuts are in the US are being debated for December. Fine. Risk is on, earnings are all right. And Trump-Xi, I don't know, did people really hedge against a political fallout from this? I mean, I think most people would say that there was always going to be a deal. There was always going to be something that came onto the target. But I don't think anything. At the moment, I'd say fundamentally this is a positioning unwind, and therefore there will be a level where people step in. But I'm not going to try and predict it. Wait for the structure to change, and then you get a high probability that the dip has been bought.
Well, my first setup, Chris, is going to be something a little bit different. It's going to be the euro, and it's going to be in a 4-hour chart. Reason why I brought up this chart is because clearly it is defined that we are in a consolidation. Clearly, we actually closed at triangle support. So I'm going to give you some clear parameters that I'm looking for. A break below today's lows. I say today, meaning the end of my day, which is the 29th, as we're wrapping up here. It is the beginning of your day, but that low comes in at it's at 115.70, basically 115.75. We break below that, and I think it opens the door for a move lower. Remember, we're coming out of a triangle. So when you come out of a triangle, this apex, it's been extremely volatile and extremely frustrating. I'm telling you from somebody who was just playing it for the last couple of days, and who I'm actually still short the euro at this moment. But I think it's a trade that if it breaks down, we're going to get some legs. There's got to be a reason, as Chris is saying about gold or about anything else that we tend to talk about. There has to be a reason, and the whatever happens with the China-U.S. trade deal, if a deal gets done, people might buy dollars because it's good for the dollar. If a deal doesn't get done, people might buy dollars because it's risk aversion and they just want to buy dollars. So tonight's going to be a really interesting reason to see if we can actually break down. But 115.75, that's the level I'm looking for.
Good stuff. Well, I want to go to the big dog. Let's go to Nvidia. Right. Well, it's obviously at all-time highs. I mean, it's just it's the thing of beauty, but it has been a frustrating trade for a lot of people. Obviously, saw the really big move between April and August, and then it's just been sort of trading sideways, consolidating. I think a lot of people were focused on some of the other AI plays. AMD was ripping at the time, going to some of the other AI plays, but also things like Alphabet was working. So people had to hold Nvidia because it's a core hold. It's 8% of the index, and therefore, if you want to go out and cheaply achieve benchmark returns, you have to have Nvidia as a core holding. But what's happened now is it has actually started working. Now, we saw GTC coming through, the conference coming through on Tuesday. Jensen Huang stepped up, does what he does best, entertains, and talks very positively about this. But what he did is he told us they were projecting revenues between CY 2025, the end of the year, into 2026, over 6 quarters effectively, of $500 billion. $500 billion. That equates to 20 million chips, GPUs being sold. They've already sold 6, so that equates to $350 billion. The market sort of said, well, is that actual guidance? Are they soft guiding revenue for that point? Because the market had revenues for that period of $314 billion. Now, if it was soft guidance, if it was actually the cat out of the bag, that's what they were expecting and not just some sort of loose target, then basically the market's offside or under in terms of its expectations by 12%. And that's a material miss. So I think what you're seeing is analysts trying to question this. Is this actual the reality? Can they ship 20 million GPUs? Blackwell is fully ramped up. You know, you've got Hopper and all these factors coming through, Rubin. But will they get to the 20 million? They've got the demand. Can they do the production? If they can, 20 million is suggested that the market was unders, which is why we've seen that big pop that we've been seeing. And in fact, you know, you could argue that if they're going to get 350 billion on top of what they've already sold, you know, the stock could even go any higher than this at the moment. So that's supporting the index. And it's really given a very frustrating trade to a lot of people, extra legs. And that's why it's the $5 trillion stock, first $5 trillion stock there. So onwards and upwards, a lot of people frustrated. They've been in AMD, other names, and now it seems like Nvidia's time to shine. Whether it builds from here is obviously another thing, but I wouldn't be betting against it at this stage.
June 2023, it was $1 trillion stock. Just over 2 years, it's a $5 trillion stock. And our friend from the trade-off show, some of you remember Tracy Schuchart. She posted something that 5 trillion is 2 times Canada's GDP.
Well, it's bigger than my bank account.
It's crazy. All right, let's move it over to soybeans. Let's talk about something that might matter here over the next couple of days to everybody. So we got this breakout in soybeans, Chris. What it was? This is obviously the U.S. Trade deal, and look at this resistance has been basically in play since mid 2024. We're breaking out. It's a nice little breakout, and this as long as we're above 1,080, that's a big breakout of a range, and a range expansion can take us well above 1150. Like, so we stopped at the 127% extension, and I think you got to just continue to be bullish while you're above that 1,080 level. Now, keep in mind tonight, as Chris pointed out, one aspect of the trade talks is China buying soybeans from the U.S. That is what provoked this breakout to the upside, and over the last couple of days. So if we can hold that, that is an upside breakout. If we get back below it, that's not going to be good for the bulls. And so
what I love about agricultural commodities is, I mean, I would have loved to have seen scenes in trading places back in the day in the old SIBO pits and CBOT, and people going absolutely low as the market breaks out. Mine. Because these things, they can rip. They can trend in a. I mean, this isn't necessarily about rain or weather patterns or necessarily thing. It's about trade. But what I love about agricultural commodities, they don't come up on retail's radar as much. But for the trend followers out there, you pay a slightly wider spread than when you would do with euro dollar, for example, or gold. But when they trend, they can absolutely go, and the duration and longevity of those trends can be lasting. That's why you get all these CTAs, trend following funds, who always are in orange juice or beans or whatever, cattle. Cattle's had a strong one. So it's been an interesting one. Obviously, it's an interesting one with. I think they have a really strong place for the traders' radar if your strategy is buying strong and holding. I guess with the emergence of the Aussie dollar now, Blake, you're going to be paying up for Australian beef, primary Australian beef in this trade deal that we've got with you guys at the moment. So some of your substandard American beef is going to be replaced by good quality Australian beef. So you'll be eating that on your plate.
As long as we get to eat it with our rare earths from Australia, that's fine.
I reckon that'd be a good, tasty combo. Do you want some rare earths with that eye fillets, Mr. Sir?
Oh, absolutely. Right. Park it under the porte-cochere, please. Yes, absolutely.
Yeah, very good, very good. We'll bet some best soybeans, rare earths, and eye fillet would go down well as a nice combo there. Anyway, let's move on. Let's go to play of the day. Right, let's go for the Ashes trade. Sterling against the Aussie. For people who don't know what the Ashes are, it's a cricket match between England and Australia that will come out in December this year. I am obviously torn, being a member of both countries. But I think an interesting one now is that the door has been open for rate cuts coming through in November from the Bank of England. There are banks calling for it now. The rates market in the UK is slowly warming to that. We've got a 26% chance or so that the Bank of England cut, but there are people calling for that. On Australia, we saw a CPI number coming out yesterday, our time, and it's basically taken off a rate cut coming off the table. Last week on Friday, there was a 60% chance that the RBA looked to cut rates. That was where the market saw that because they were still sort of disseminating the recent employment report. But Michelle Bullock earlier in the week basically poo-pooed that and said that 4.5% rate is still very much in full employment around Nauru, and she wasn't too concerned about that. But the inflation number we saw yesterday has just effectively taken that off the table. And I think, big call of the day, I think the RBA are done cutting. I think they'll be on hold for a long period of time. And I think when we get the Q4 CPI numbers that come out on the 28th of January here in Australia, if unemployment settles back down, given that growth is continuing to push into and will be above potential, which will increase demand and therefore be inflationary, household consumption is going to rise from 0.9% into Q3 numbers to about 2.6%. The private sector is showing green shoots. Fiscal is still very strong, so the public sector is getting buoyant from that. But with all these factors, if that Q4 CPI number doesn't show signs of payback, which is what the RBA expect, if it stays firm with both trim mean outside of the and headline outside of the target band, the conversation in my mind will switch to when the next move could be a hike as opposed to the next move being a cut, something that the market hasn't interest. And I think that would be one of the first central banks where that development, apart from the Bank of Japan, is actually happening. So I think we need to keep an open mind. I know a lot of people will say, Chris, you're an idiot, blah, 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 but I think those are the dynamics I'm looking at. I'm not calling rate hikes anytime soon, and if they do happen, they'll be very shallow. But I think if those developments take place, and the Q4 CPI numbers, which I say comes out on the 28th of January, doesn't show any signs of payback and stay outside the target band, then the conversation in my mind will shift, if it doesn't before that point, to the next move being a hike as opposed to down.
Whew, that would be something. I don't want to be short the Aussie, and especially when Chris is behind it. All right, let's take a look at the dollar MEX. This is going to be my Fiesta trade, and I think it's about Fiesta time. Yeah, I used to call it Taco. It's Taco Tuesday, but, I kind of wore that one out. But look at this consolidation, Chris. I'm not long, by the way. I'm not long. I'm looking for a breakout. I'm looking for a reason to be a buyer. But a breakout above 1850, you target 1864. Above 1864, you're looking at 19. Remember the low, if you go back to just to the middle of this chart, that low was very, very close, within a whisker of the long-term 618 golden Fibonacci ratio that you guys know I love to trade against. And I was buying dollar MEX at 18.2200 when we were down there. And even though I haven't been playing it as of the last couple of weeks, I think it's just about party time, or as they say in Mexico, time to grab a Corona and have a Fiesta. So it's almost Fiesta time. I'm looking to buy the dollar MEX, and I think the party's about ready to start, Chris. So that is my play of the day.
Good stuff. Love it. All right. Well, thank you, Blake. Thank you, everyone at home, for sticking around and watching it. Tell your friends and family. Like the show. Please, obviously, lay your questions down there. We'll get to those when we can, and just let us know how you're trading the market or feeling about the market and some of the views that we've said today. And we'll see you back next week for more of the trade-off.